Welcome back. So in this video, I'm going to try to cover these four. I don't think it will be a long video. Number one, as a retail day trader, avoid rollover. Number two, when is rollover? When is the next day? Number three, when is the most volume? Number four, why is large volume important? You're probably thinking, yes, you've thrown all the information at me, but I'm so confused.
I'm so damn confused.
Why don't you purify yourself in the waters of Lake Minnetonka?
So the first topic, as a retail day trader, avoid rollover. And how do you do that? You do that by closing out your position. First, let's talk about closing out a position. So here we have a graph, and you are wondering what it's going to do, and you decide that, okay, I think it's going to go up, so I'm going to open my position with a buy order. On the other hand, you think, no, I think it's going to go down, so you're going to open a position with a sell order. And then time happens, right? There is where you opened your position with either a buy or a sell order. And then at some point in the future, you close the position. If you did a buy order, you close it by doing a sell order. And if you did a sell order, you close it by doing a buy order. So you just essentially close the position by doing the opposite of what you did to open the position. We were going to discuss avoiding rollover, and you do that by closing the position. So first, let's define a little bit what rollover is. Let's say that the end of the trading day occurs here. If I open a position and close the position before the next trading day, then I avoid rollover. On the other hand, let's say that I hung on to my open position when the next trading day occurs, then because of the way the retail Forex market works, and we're not actually receiving any currency, we're not taking possession of any new currency, to avoid settlement like you do in stocks, they just automatically roll it over. So in any case, if your open position crosses into the next day trading boundary, it is going to be rolled over and you're going to start incurring fees. Okay, topic number two. So when is rollover? When is the next day? When is the next trading day? So the first thing that you need to understand that unlike the stock market, where it's typically so, if we're sitting in the United States Eastern Time Zone, stocks market, the daytime trading hours are 9:30 a.m. to 4 p.m. Then before 9:30 a.m., sometime after midnight, 2 o'clock in the morning, different brokers have different hours, but essentially that's pre-market before 9:30 a.m. and then after 4 p.m. to a certain amount of time, around 8 p.m. or so, that's after market hours, and then the markets close. In Forex, it's really become a 24 around the clock way of trading, and so really we just have a boundary. So this would be day one, and then if you cross into the 5 p.m. boundary, you're now in the next day until the next 5 p.m. boundary, and then you're into the next day after that until the next 5 p.m. boundary. So if you open a position here, you have to close it before you cross 5 p.m. One last note about that is that we're talking about Eastern time zone, so it's 5 p.m. Eastern time. The next topic, number three, is when is the most volume? Before we can discuss high volume or the most volume, we need to talk about or introduce that there are four major Forex markets, and these are their hours, and you should memorize these. So we have London, New York, Sydney, and Tokyo. And with that being said, Sabrina from Investopedia did a really good job drawing here, so I'm just going to use her drawing. So here we have a timeline of a 24-hour period, and these are representations of the trading hours for the four major trading markets, Forex trading markets, or also referred to as sessions. And so we start here at 5 p.m., and then there's midnight, 5 a.m., noon, and then I took the liberty of adding a 5 p.m. over here. So we also then know from before that 5 p.m. is the trading day boundary. So there's one, and there's the other 5 p.m. trading day boundary. So this comprises the trading day, and this would be the previous trading day, and that would be the next trading day. So if you opened a position in the previous trading day, you want to make sure you don't roll it over to the current trading day. Likewise, you don't want to roll it over to the next trading day. Now that we have established where we are here, the next thing is to talk about the most volume. And if you'll notice here, more volume is a darker color, less volume is light. So based on that, this shaded area, this outline area seems to be the most volume. Now these are 2020 figures. So that basically is around 7 a.m. till about 1 p.m. is your broad, heavy volume window, and it is because of the overlap between London and New York. There's also another smaller window of some volume, 6 to 7:30 p.m., not quite, and that is Sydney with some of Tokyo. So over here would be your best trading time. And we arrive at the last talk for this video. Why is large volume important? If you remember from our series on penny stock, we talked about how a lot of volume was good for us as penny stock traders because it typically would generate large amount of volatility, whereas low volume would have very little volatility and very little chance to enter and exit and take profit, make money. Now I want to go over another reason a lot of volume is important in Forex, and but I'm going to use the penny stock world to show the problem with the lack of volume. So again, let's say volume's down here. Typically with these low volume penny stocks, you'll have very little volume. Normally it's shown as bar charts, but I don't want to do that. So very little volume. Then all of a sudden you can have this large spike of volume where someone dumped or bought a lot of shares and then back to low volume again. And what that happens with the share price is that it's going along, and then all of a sudden, let's say that the volume was caused by a sell-off. Well, then it plummets, and then then it must probably try to hopefully crawl back up until the next spike, and so on. So what we're saying is that low volume with these random spikes affects the share price quite a bit. And then in turn, what it means is that we are going to have a very difficult time doing things like technical analysis because we can't predict it because this low volume, added in with the random spikes. So that's the problem, is the The low volume and the sporadic spikes make technical analysis almost impossible to do. I wanted to show you 3 examples to finish off this topic. So here we have a penny stock that I'm familiar with, NSAV. One of the things I want you to notice is, like I said, the sporadic volume. And here we have, for instance, a large spike in volume. Look at the variance in price. Another large spike, variance in price. Let's go, so that's like an OTC penny stock. Let's go to NASDAQ and Apple. Now Apple has more of regular volume, but there was a spike here. Now, the one thing that Apple has over the penny stock is, for example, not just the volume and the price being affected by the volume, but look at all these doji candles. It's hard to do technical analysis on something like this. With Apple, it's better. You've got all these, long candles, and you can definitely do some technical analysis with Apple. Now, finally, though, let's go to, for example, Forex, the Euro USD pair. Look how regular the volume is there. And look at all these candles. And the swing isn't as much as even, for example, Apple, definitely not for NSAV. So this makes it easier to do your technical analysis. And that completes this video for today. Thank you.